Have you ever wondered how currency came to be? In this video, we'll go back in time to the colonial era in America where each colony printed their own paper money, leading to confusion and inflation. We'll also explore the introduction of the gold standard in the late 1800s, a system designed to stabilize currencies and control inflation. But as the world faced the Great Depression of the 1930s, many countries abandoned the gold standard in an effort to stimulate their economies. Fast forward to today, where the economy is a complex machine made up of businesses, banks, and people. We'll delve into the different factors that contribute to economic fluctuations, including inflation, job loss, and external events. Join us as we uncover the history and inner workings of the money and economy and why it matters. In our last video, we saw the beginnings of money with bartering, why it failed, the use of metal coins and its limitations. In the 17th century, the American colonies were suffering from a shortage of coins due to trade imbalances with Europe, which made it difficult to carry out everyday transactions. To address this issue, the colonial governments began to issue paper money in the form of bills of credit that could be used as a medium of exchange. The issuance of paper money increased significantly during the American Revolution, as the Continental Congress needed to finance the war effort. The continental currency was issued in large quantities but quickly lost value due to inflation and a lack of backing by precious metals. After the revolution, the individual states continued to issue their own currencies, which caused confusion and created difficulties in trade between the states. This situation was resolved with the creation of a national banking system and the issuance of a national currency, the US dollar, by the federal government. The gold standard was introduced in the late 1800s as a way to stabilize currencies and control inflation. Under the gold standard, paper money was pegged to a specific amount of gold. This meant that if a government wanted to print more money, they would also have to have an equivalent amount of gold to back it up. This made it more difficult for governments to print too much money and caused inflation to decrease. In 1873, many countries including the United States adopted the gold standard, which helped stabilize currency and lower inflation. However, during the Great Depression of the 1930s, many countries abandoned the gold standard as a way to stimulate their economies. The United States was the last major country to abandon the gold standard in 1971, under President Nixon. It was removed because it was seen as a constraint on government's ability to stimulate the economy by controlling the money supply. Overall, the gold standard was introduced to control inflation and stabilize currencies, but it was removed because it was seen as an obstacle to economic growth. Let's talk about economy and why it matters. Economy is like a big machine that helps to make sure everyone in a country has what they need to live, like food, clothes, and a place to live. The economy is made up of many different parts, like businesses, banks, and people who work and buy things. Just like a machine, the economy can sometimes run smoothly and sometimes have problems. These ups and downs in the economy are called economic fluctuations. Imagine you and your friends are planning a road trip across the country. Your budget for the trip is limited and you have to make some tough decisions on how to spend your money. The choices you make and how much you spend will impact your overall experience on the trip. This is similar to what happens in an economy. The choices people make on how to spend their money can cause economic fluctuations. There are several key factors that contribute to these economic fluctuations, like changes in consumer spending, investment, government spending, and international trade. Let's break it down. Just like how you and your friends decide where to eat and what to do, consumers in an economy decide what to buy and how much to spend. This can impact the overall level of economic activity, especially if a large number of consumers suddenly stop spending or start spending more. Businesses also play a big role in economic fluctuations. When businesses invest in new projects or equipment, it can create jobs and boost economic growth. But if businesses stop investing or reduce their investments, it can slow down economic growth. The government can also impact economic fluctuations through its spending decisions. For example, if the government invests in infrastructure projects, it can create jobs and stimulate the economy. On the other hand, if the government cuts spending, it can slow down economic growth. Just like how your road trip could take you across different states, the economy can also be impacted by what's happening in other countries. If a country exports more goods and services than it imports, it can boost its economy. But if it imports more than it exports, it can slow down its economy. The central bank, like a traffic cop, can also impact economic fluctuations through its decisions on interest rates. If the central bank lowers interest rates, it can encourage borrowing and spending, which can boost economic growth. But if it raises interest rates, it can slow down borrowing and spending, which can slow down economic growth. Sometimes external events can also cause economic fluctuations. For example, a natural disaster like a hurricane can destroy homes and businesses, which can make it hard for people to make money. A war can also make it hard for businesses to make money because they can't trade with other countries. These events can cause a decline in the economy. One example of a historical event that caused economic fluctuations is the Great Depression. The Great Depression was a time in the 1930s when the economy was really bad all over the world. Many people lost their jobs, and businesses closed down. This was because there wasn't enough money to buy things, and people didn't have enough money to spend. This made it hard for businesses to make money, which led to more people losing their jobs. This cycle kept going until the economy was really bad. The need to control the economy is important because when the economy is doing well, people have jobs and money to buy things they need. But when the economy is not doing well, it can be hard for people to find jobs and make money, which can make it difficult for them to buy things they need. This is why it's important for governments and other organizations to try to control the economy, to make sure it stays stable and people can continue to have what they need. There are many different ways to control the economy, but some of the most common ways include monetary policy, fiscal policy and regulation. Monetary policy is when central bank controls the amount of money in the economy. For example, they can print more money to make it easier for people to buy things, or they can take money out of the economy to make it harder for people to buy things. Fiscal policy is when a government controls how much money it spends and how much money it takes in through taxes. For example, they can spend more money to create jobs, or they can take in less money through taxes to make it easier for people to keep more of their money. Regulation is when a government or other organization sets rules for how businesses and other organizations can operate. For example, they can set rules to make sure that businesses treat their employees fairly, or they can set rules to make sure that banks don't take too much risk. One example of a historical event where the government controlled the economy is during World War II. The government needed to increase the production of goods and services to support the war effort. They did this by setting up war production boards that controlled what goods and services were produced and how they were produced. This helped to increase the production of goods and services, which helped to boost the economy. In our next video, we'll delve deeper into what is inflation, why countries have central bank and how it affects our lives. Thank you for watching the video and I hope you enjoyed watching it. Don't miss out on any of the future videos. Press the like button, subscribe to my channel and hit the notification bell to stay updated on all of the latest content. Make sure to share it with your friends and family so they too can join in on the fun and learning. Leave a comment below and let me know what you liked about this video and what you'd like to know more about. Your feedback will help create content that is relevant and interesting to you.